While gold has long been the preferred hedge for the ultra-wealthy, a new, quieter movement is reshaping the precious metals landscape. Billionaires, hedge funds, and top-tier investors are secretly accumulating platinum, positioning themselves for a surge that could potentially outpace gold itself. This is not about headlines or speculative trading. It is about strategic foresight, understanding the fundamental forces driving platinum demand, and anticipating a market imbalance that most retail investors are unaware of. 1. Platinum is rarer than gold, with annual production significantly lower. Its unique industrial applications make it a dual-purpose asset, both a store of value and a critical component in technology and energy markets. Unlike gold, which is primarily an investment or hedge, platinum has real-world demand embedded in automotive catalysts. Platinum is essential in catalytic converters, reducing harmful emissions. Hydrogen fuel technology. As the energy sector pivots, platinum becomes indispensable in fuel cells. Industrial applications, from electronics to chemical processing, platinum is critical. The scarcity and industrial necessity create a situation where platinum's price floor is supported by demand, unlike other metals vulnerable to speculative bubbles. 2. Billionaires. See the hidden potential. Ultra-wealthy investors often have access to market data and industrial insights unavailable to the general public. Many have quietly recognized platinum's potential for supply constraints. Platinum mining is geographically concentrated, with South Africa dominating global output. Political unrest, labor strikes, or operational disruptions can dramatically reduce supply. Growing industrial demand, transitioning technologies, particularly green energy initiatives and hydrogen fuel adoption, are creating unprecedented demand. Correlation to gold, but with upside potential. Historically, platinum trades at a discount to gold, but structural shifts could see it surpass gold in value per ounce. This combination of scarcity, industrial demand, and market inefficiency makes platinum a strategic asset for long-term wealth preservation. 3. The quiet accumulation strategy. Billionaires are not announcing their moves. They are buying physical platinum, bullion bars, coins, and allocated vault holdings, platinum ETFs and funds for those who want exposure without physical storage challenges, direct industrial stakes. Some invest in platinum-producing mines or technology ventures relying on platinum. This quiet accumulation prevents sudden price spikes that could alert the broader market prematurely. By acting discreetly, they position themselves ahead of the inevitable surge, maximizing profit potential while minimizing risk. 4. Market imbalance and price potential. The platinum market is small and thinly traded compared to gold. This means a relatively small influx of demand can dramatically impact price. Supply interruptions, due to strikes, geopolitical tension, or logistical constraints, magnify the effect. Investor accumulation alone can tighten available physical supply, creating upward pressure on price. In essence, platinum is primed for volatility and potential explosive growth, especially as industrial demand accelerates. 5. Industrial drivers. As a hedge, platinum's industrial role differentiates it from gold. While gold is predominantly financial, platinum is embedded in the global economy. Automotive catalysts, environmental regulations drive adoption, and electric hybrid vehicles still rely on platinum for catalytic processes. Green energy transition, hydrogen fuel cells, and renewable technologies require platinum as a catalyst, a demand set to grow as governments invest in clean energy. Electronics and chemicals, essential in manufacturing and chemical processing, ensuring persistent demand. These drivers mean platinum's price is less speculative and more grounded in real economic necessity, giving it a stronger foundation for growth compared to gold. 6. Historical context. Historically, platinum has often traded below gold despite being rarer. Reasons include higher industrial dependence leading to cyclical demand, less retail investment interest, smaller, concentrated supply chains. However, as industrial applications expand and scarcity becomes more acute, platinum is poised to break free from historical patterns, potentially exceeding gold in both price and investment prominence. 7. Risk management and wealth. Preservation billionaires accumulate platinum not just for profit, but as a hedge against systemic risk. Currency devaluation. Physical platinum preserves purchasing power during fiat instability, market uncertainty. Industrially backed demand ensures platinum retains intrinsic value even if broader markets falter. Geopolitical shifts. Concentrated mining regions make physical accumulation a strategic buffer against regional disruptions. This dual nature, both financial and industrial, makes platinum an attractive component of a diversified wealth strategy. 8. Signals to the market. While the public may not notice, subtle market signals indicate accumulation, rising premiums on physical platinum relative to spot prices, increased activity in specialized platinum ETFs, strategic mining investments by institutional players. These trends suggest a quiet positioning for an imminent price surge, mirroring historical patterns observed when elite investors enter emerging markets ahead of mainstream adoption. 9. The psychology of elite investors. Billionaires operate differently than retail investors. They focus on asymmetric risk-reward opportunities. They anticipate systemic and industrial trends years in advance. They prioritize asset preservation and strategic advantage over short-term gains, growing industrial necessity and undervalued market. This makes platinum not just an investment, but a strategic positioning tool in the evolving global economy. 10. Conclusion. Setting the stage for Part 2. The quiet accumulation of platinum by billionaires signals a broader trend. Platinum's scarcity and industrial demand create a price floor and growth potential. Historical undervaluation relative to gold presents upside potential. Strategic acquisition by elite investors positions platinum as a major emerging asset class. In Part 2, we will explore why platinum could outperform gold, diving into scarcity, industrial applications, and comparative market dynamics that may push its price above gold's, creating one of the most compelling investment narratives of the decade. Gold has long been the king of precious metals. Its historical role as a store of value, hedge against inflation, and a symbol of wealth is unmatched. Yet, in the shadows, platinum is quietly positioning itself as the next major contender with the potential to outperform gold in price and strategic importance. Billionaires and institutional investors are not following trends. They are anticipating them. By examining scarcity, industrial demand, and market dynamics, we can understand why platinum could eclipse gold in the near future. 1. Scarcity and supply constraints. Platinum is far rarer than gold. Annual global production is significantly lower, with South Africa and Russia dominating supply. South Africa contributes roughly 70% of global production, often subject to labor strikes, energy shortages, and political volatility. Russia's platinum supply is tied to geopolitical tensions and export controls. Unlike gold, which has widespread mines across multiple continents, platinum's supply is geographically concentrated, making it more sensitive to disruptions. This scarcity means even modest increases in demand can trigger substantial price spikes. Unlike gold, which has large reserves and relatively predictable production, platinum's limited supply creates asymmetric upside potential. 2. Industrial demand outpacing gold. While gold is primarily an investment asset, platinum is embedded in industrial use. Automotive catalysts, regulatory requirements. For emissions reduction drive, consistent platinum demand. Hydrogen fuel cells. As global energy transitions toward green alternatives, platinum's role as a catalyst in hydrogen production and fuel cells is irreplaceable. Electronics and chemical industries, platinum's chemical properties make it essential for advanced electronics, medical devices, and industrial applications. The combination of scarcity and rising industrial demand creates a structural market imbalance. Where gold is influenced mainly by investor sentiment, platinum is tied to tangible global economic activity, strengthening its price foundation. 3. Historical price patterns and platinum's undervaluation. Historically, platinum is often traded below gold, despite being rarer and harder to produce. Factors include higher reliance on industrial demand, making its price more cyclical, limited public awareness and retail investment compared to gold. Smaller, thinly traded markets. However, shifts in industrial application and strategic accumulation by billionaires suggest this historical discount may disappear or even reverse. Platinum is positioned for a breakout, potentially surpassing gold in value per ounce. 4. Technological and energy drivers. Platinum's future is closely linked to technological adoption. Hydrogen economy, governments worldwide are investing in hydrogen fuel infrastructure. Platinum is a critical component in fuel cells, creating long-term, non-cyclical demand. Electric vehicle hybrids. While fully electric vehicles reduce platinum demand, hybrids and catalytic systems in developing markets still rely on it. Renewable energy. Storage. Platinum catalysts improve efficiency and durability in energy storage systems. These trends mean platinum is not just a precious metal. It is a critical industrial input, ensuring consistent demand regardless of macroeconomic fluctuations. 5. These dynamics create a market environment where platinum is both undervalued and positioned for significant outperformance. 6. Geopolitical factors. Enhancing platinum's value. Platinum's concentrated supply and strategic industrial use give it geopolitical significance. South African mining strikes, labor disputes can disrupt a large portion of global production, instantly affecting prices. Russian production and sanctions, political decisions impacting export can tighten supply chains. Global energy transition. Nations investing in hydrogen fuel and renewable technology increase demand for platinum, reducing its availability in speculative markets. These geopolitical and industrial pressures reinforce platinum's scarcity premium, giving it a strong edge over gold. 7. Investor strategy, positioning for platinum's surge. Billionaires are employing several strategies to capitalize on platinum's potential. Physical holdings, accumulating bars, coins, and allocated vault positions ensures exposure to the metal's intrinsic value. ETFs and funds, investors gain liquidity while positioning for price appreciation. Mining equity stakes, strategic investments in platinum producers provide both financial and operational leverage. Industrial partnerships, aligning with companies dependent on platinum guarantees access and influence over supply. This approach mirrors previous gold surges but benefits from industrial demand backing, increasing the probability of sustained outperformance. Platinum is no longer just an industrial metal or niche investment. Its scarcity, industrial demand, technological applications, and strategic accumulation by billionaires position it to potentially outperform gold in both value and strategic importance. In Part 3, we will explore global market drivers and industrial catalysts that could accelerate platinum's rise, including automotive, energy, and technology sectors, as well as how these forces intersect to create one of the most compelling precious metal narratives of the decade. While gold has dominated headlines for decades, platinum's rise is driven not just by investor demand, but by industrial necessity. The combination of scarcity, strategic accumulation by billionaires, and rapidly expanding industrial applications is creating a perfect storm that could propel platinum past gold in price and strategic relevance. To understand why, we need to examine the industrial drivers, global market dynamics, and technological trends that are quietly reshaping the platinum landscape. 1. Automotive catalysts, the heart of industrial demand. Platinum is a critical component in catalytic converters, which reduce harmful emissions from internal combustion engines. Even with the rise of electric vehicles, catalytic systems remain essential. Hybrid vehicles, while fully electric cars reduce platinum demand, hybrid vehicles still require catalytic converters. With hybrids gaining global market share, platinum consumption remains robust. Emission regulations. Countries worldwide are tightening environmental standards, increasing the need for platinum-based catalysts. Supply sensitivity. Any disruption in platinum production, particularly in South Africa or Russia, can immediately affect automotive supply chains, creating upward pressure on prices. Automotive demand alone represents a baseline of industrial consumption, giving platinum a strong support level compared to gold. 2. Hydrogen economy. Platinum as a strategic fuel. One of the most transformative drivers is the emerging hydrogen economy. Fuel cells. Platinum acts as a catalyst in hydrogen fuel cells, which convert hydrogen into electricity efficiently and cleanly. Global green initiatives, governments, and corporations are investing heavily in hydrogen infrastructure to reduce carbon emissions. Industrial insulation, platinum demand in hydrogen technologies, ensures that even in volatile financial markets, industrial consumption supports its value. This dual role, both financial asset and critical industrial input, positions platinum uniquely among precious metals. 3. Electronics and high-tech applications. Platinum is also indispensable in various technological applications. Electronics, used in sensors, semiconductors, and microelectronics. Medical equipment, essential for implants, surgical tools, and other medical devices. Chemical industry, acts as a catalyst in refining and chemical production, ensuring high demand even in global economic downturns. These industries insulate platinum from speculative swings that often affect gold, making its price movements more predictable and supported by real-world demand. 4. Market dynamics. Supply and demand imbalance. Platinum's market is smaller and more concentrated than gold, which creates unique dynamics. Thin market, small trades, can create significant price swings. Strategic accumulation. Billionaires and institutional investors reduce available supply by holding physical platinum or contracts. Industrial contracts. Companies securing long-term platinum supply tighten liquidity, amplifying upward price pressure. This imbalance creates a scenario for explosive price movement, particularly if industrial demand surges or supply is disrupted. 5. Geopolitical factors. Platinum's global supply is heavily concentrated. South Africa, dominates production but faces labor disputes, energy shortages, and political volatility. Russia. Exports are sensitive to geopolitical tensions and sanctions. Trade dependencies, any disruption in major supply regions can immediately impact global availability, creating rapid price movements. These geopolitical factors add a risk premium to platinum, further enhancing its potential to outperform gold. 6. Investor behavior and strategic accumulation. Billionaires are quietly positioning themselves to exploit these dynamics. Physical holdings, bars, coins, and allocated vault positions provide direct exposure. ETFs and funds offer liquidity while maintaining strategic positioning. Mining equity stakes, direct investments in producers ensure access and leverage over supply. Industrial partnerships, aligning with platinum-dependent companies secures future availability. This quiet accumulation limits supply in the open market, creating upward price pressure even before demand surges publicly. 7. Platinum versus gold. Industrial leverage. Unlike gold, which is primarily a financial asset, platinum's industrial applications provide a structural advantage. Gold relies heavily on investor sentiment, which can fluctuate dramatically. Platinum is backed by real-world consumption, giving its price foundation stronger durability. As industrial adoption of hydrogen and hybrid technologies grows, platinum demand could exceed supply sustainably, creating a breakout scenario. This industrial leverage differentiates platinum from gold, making it a strategic hedge and growth asset simultaneously. 8. Signals from the market. Several market indicators suggest platinum is approaching a major inflection point. Rising premiums on physical platinum relative to spot prices, increased activity in ETFs and industrial supply contracts, strategic accumulation by billionaires and institutions, concentrated supply vulnerable to disruption. These signals mirror historical patterns preceding major surges in precious metals, indicating that platinum is quietly primed for explosive growth. 9. Potential catalysts for platinum's surge. Several catalysts could trigger a rapid ascent. Hydrogen adoption accelerates due to green energy policies. Geopolitical disruptions in South Africa or Russia restrict supply. Industrial demand spikes as automotive and chemical sectors expand. Investor accumulation intensifies, further tightening market availability. These catalysts, working together, create a perfect storm for platinum, unlike gold, which is more influenced by monetary policy and investor speculation alone. 10. Conclusion. Setting the stage for Part 4. Platinum is no longer a niche industrial metal. It is scarce and concentrated in supply. Critically important for industrial applications, particularly in automotive and hydrogen technology. Quietly accumulated by billionaires and institutions, anticipating a surge positioned to potentially outperform gold in both price and strategic relevance. In Part 4, we will explore strategic wealth preservation, investment positioning, and the road ahead for platinum, concluding the script with a strong like and subscribe CTA for Hidden History Vault. Platinum has quietly moved from being a niche industrial metal to a strategic financial asset. Billionaires and institutional investors have recognized its scarcity, industrial necessity, and potential to outperform gold, positioning themselves for a historic surge. Part 4 examines the strategic implications, investment strategies, and future trajectory of platinum, while exploring how average investors can understand and navigate this emerging frontier. 1. Platinum as a dual-purpose asset. What makes platinum unique is its dual role. Financial asset. Like gold, platinum preserves wealth, hedges against inflation, and acts as a tangible store of value. Industrial asset. Unlike gold, platinum's applications in automotive catalysts, hydrogen fuel cells, electronics and chemical processes create a baseline demand that is independent of market sentiment. This dual nature provides resilience and strategic leverage. Where gold's price can fluctuate primarily due to investor psychology, platinum has both speculative upside and industrial support, making it a compelling long-term hedge. 2. Strategic wealth preservation. For billionaires, platinum serves as a critical portfolio diversification tool. Physical holdings, allocated vaults, bars, and coins protect against fiat currency instability and systemic financial shocks. Platinum ETFs and funds provide liquidity while maintaining exposure to potential price appreciation. Mining equity stakes, direct investment in platinum. Producers ensures strategic access to supply and potential upside from production expansion or market disruptions. Industrial partnerships, tying holdings to companies dependent on platinum, secures access while benefiting from industrial growth trends. Through these strategies, platinum is both a defensive and offensive wealth preservation tool, ensuring protection against currency devaluation while providing significant upside. 3. Anticipated price surge. Several factors indicate platinum's potential to outperform gold. Industrial demand growth, green energy, hydrogen adoption, and automotive regulations create structurally increasing demand. Supply constraints. Production is concentrated in South Africa and Russia, vulnerable to strikes, geopolitical tensions, and logistical issues. Strategic accumulation. Billionaires' quiet accumulation reduces liquidity, creating upward price pressure. Historical discount. Platinum has historically traded below gold despite being rarer and essential in industry, suggesting significant upside potential. The combination of these forces creates a scenario where platinum could not only match, but surpass gold in value, both as a commodity and a strategic asset. 4. Global market implications. Platinum's surge will have ripple effects across global markets. Commodities. Prices for platinum-linked industrial goods and catalysts will rise. Currency and investment flows. Investors seeking protection against inflation or currency risk may increase allocations to platinum. Geopolitical impact. Countries dependent on platinum supply may gain strategic leverage, while nations without access may face industrial constraints. These dynamics make platinum not just a market opportunity, but a driver of structural change in commodities, trade, and global investment flows. 5. Industrial revolution and platinum. The green energy transition positions platinum at the center of technological and industrial evolution. Hydrogen fuel cells, essential for clean energy storage and power generation, require platinum catalysts. Automotive industry. Catalysts in hybrid vehicles maintain a baseline industrial demand, independent of speculative trading. Electronics and chemicals. Industrial applications anchor platinum demand in non-negotiable sectors, insulating it from market swings. This integration of industrial necessity with financial speculation makes platinum uniquely positioned for both growth and stability. 6. Strategic positioning for investors. Investors seeking exposure to platinum should consider a multi-pronged approach. Direct physical holdings, bars, coins, and allocated storage ensure direct control and tangible value. Platinum ETFs and derivatives. For those seeking liquidity and market access, these financial instruments provide efficient exposure. Mining equity. Investing in producers captures both metal value and operational leverage. Industrial partnerships. Collaboration with companies dependent on platinum secures supply and strategic influence. This diversified approach mirrors billionaire strategies, aligning wealth preservation with opportunity capture. 7. Timing the surge. While platinum is quietly accumulating value, timing is critical. Early movers. Gain advantage. Billionaires have already positioned themselves, capitalizing on market inefficiencies. Supply disruptions. Trigger price jumps. Labor strikes, geopolitical events, or industrial demand spikes can rapidly increase platinum's market value. Industrial adoption accelerates. Green energy initiatives and hydrogen adoption create a long-term structural support for prices. Understanding these timing mechanisms allows both large and smaller investors to strategically align with the expected surge. 8. Psychological dynamics of platinum markets. Investor psychology amplifies platinum's trajectory. Early adoption confidence. Those recognizing scarcity and industrial demand gain strategic advantage. Validation effects. Rising prices reinforce early decisions, prompting additional accumulation. Herd behavior. Market participants, fearing missed opportunity, drive momentum further. Platinum's growth is as much psychological as it is structural, with billionaires' quiet accumulation signaling broader market expectations. 9. Risks and considerations. No market is without risk, and platinum has unique considerations. Concentration risk. Production is geographically limited. Supply disruptions can create extreme volatility. Industrial dependency. Shifts in technology could alter demand for catalytic applications. Market speculation. Sudden speculative moves can temporarily overshoot intrinsic value. Strategic investors mitigate these risks through diversification, industrial partnerships, and long-term positioning. 10. Conclusion. Road ahead and strategic takeaways. Platinum is no longer a niche asset. It is emerging as a strategic store of wealth and industrial powerhouse. Billionaires' quiet accumulation signals a market ready for explosive growth, potentially surpassing gold in value and importance. For investors and observers, understand the industrial and scarcity drivers behind platinum's rise. Recognize the strategic accumulation by elite investors as a market signal. Prepare for price surges triggered by industrial demand, supply disruptions, and geopolitical factors. Consider a diversified strategy combining physical holdings, ETFs, mining equity, and industrial partnerships. Platinum's ascent is not just financial. It represents a new frontier in wealth preservation, industrial strategy, and global market dynamics. This concludes our Hidden History Vault exploration of why billionaires are quietly buying platinum before it explodes past gold. If you want to stay ahead of these trends, understand the forces shaping global wealth, and discover the next big strategic asset, like this video, subscribe to Hidden History Vault, and stay prepared for the next wave of global financial shifts.